Hello, I'm Consuelo Mack. I want to tell you about a new opportunity to watch Consuelo Mack Wealth Track before the program appears on public television. As a subscriber, you can see programs 48 hours in advance of the general public and also find timely interviews and commentaries exclusive to Wealth Track Premium subscribers. If you're interested, just go to wealthtrack.com for more information. Thank you. This week on Wealth Track, First Eagles portfolio manager Matthew McLennan is known for steering a steady course through heavy global seas in search of secure long-term values. Where is he finding hidden treasures? Find out next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Did you know you can take Wealth Track with you? You can watch full episodes, you can watch the highlights, or read the newsletters, whenever, wherever. Let me show you how. In your web browser, type in m.wealthtrack.com. That's it. So join Wealth Track whenever and wherever you can. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. Ever since we launched Wealth Track in 2005, our focus has been on identifying long-term trends that would affect your financial health and investment decisions. One of the most pronounced has been what we call the New World Order, the changing economic, market, and political landscape creating new global winners and losers. Wealth Track guest Neil Ferguson describes it in his latest book, Civilization, the West and the Rest, his analysis and history of the West's 500-year ascent to world economic, military, and cultural dominance, and the current rise of the rest, the emerging world's growing economic and political power and influence. One of the starkest recent examples of the global shift was the downgrade of the credit ratings of the government bonds of 9 European countries, including France, Europe's second and the world's 5th largest economy, which lost its coveted AAA status. That follows the once unthinkable downgrade of U.S. Treasury debt from AAA late last year. Meanwhile, emerging market governments have seen their credit ratings improving. Over half are now rated investment grade. Starting 7 years ago, another Wealth Track guest, top-ranked Washington analyst Tom Gallagher, predicted the return of big government and its expanding involvement in both the public and private sector. Both developments are part of the New World Order. An obvious example was the Federal Reserve and U.S. Treasury's involvement in rescuing major banks and companies during the financial crisis. An example now being followed by the European Central Bank, which is providing funding to Eurozone governments and banks. According to independent research firm Strategas, the ECB's long-term lending facility has provided banks with 3 years' worth of liquidity to prevent government and bank failures. The New World Order is a focus we share with many of our Wealth Track guests, who are chosen because of their ability to successfully navigate these sometimes seismic and other times subtle shifts. This week's guest is one of this select group. He is Matthew McLennan, portfolio manager of First Eagles Global, Overseas, and U.S. Value Mutual Funds, and the successor to legendary value manager Jean-Marie Eveillard. McLennan picked up his mantle without skipping a beat. The flagship First Eagle Global Fund, which he joined in late 2008 in the midst of the financial crisis, is in the top 20% of its world allocation fund category in the last 3 and 5 year periods, and in the top 2% for the decade. I began the interview by asking McLennan to name the biggest global changes he is tracking and how he is responding to them.
If you look at the state of the world today, you have to look at it holistically and take notice of the fact that many of the real structural challenges that face the world economy, be they demographics, be they high and volatile energy prices, be they phase shifts in the competitiveness between nations, are producing economic transitions. And the policy response to those economic transitions has been one of easy money, very low or even negative real interest rates, and one of ballooning central bank balance sheets. And that's produced a degree of financial vulnerability for the medium term that has to be laid on at the top of those fault lines that exist. And so in looking at the state of the world today, we really focused on not just the real forces that are at work, but the financial distortion that sits atop that.
Let me stop you right there, because most of the other people that we hear from on Wall Street say, if anything, that involvement of central banks has created financial stability in an unstable environment that they've actually helped. You're saying that it's actually imposing instability?
Perversely enough, the illusion of stability over time will produce its own vulnerability. There was an economist, Minsky, who talked about this phenomenon.
The Minsky moment, right?
Exactly, where stability breeds its own instability. And I think that what we observed through the period of the 2000s was this illusion of the great moderation, that we had a policy backdrop, inflation targeting, etc., that could produce low and stable inflation and predictable economic growth. People built vulnerable capital structures on the back of that illusion, and we saw the consequences of that in 2008.
Right, so that was under Greenspan essentially, well, and then Bernanke, but this idea that we have done away with the cyclicality in the economy, and that the central bankers have essentially figured out this system so that we can avoid the kind of cyclical swings that we've had historically.
Absolutely, and if you look at how that's evolved today, monetary policy, rather than just being a palliative to take the edge off a confidence crisis, to provide liquidity at that moment of maximum distress, is now being seen as a cure in and of itself. But yet we know in the abstract, the art of printing money can't make all people wealthier. And so we have this situation where real interest rates, even going out a decade today, are negative. And that if we look at the balance sheets of the central banks around the world, they've ballooned, more than doubled in many instances. At a certain point, people are waking up to the realization that there is not a risk-free asset today. There's not an asset that you can invest in that will give you the real return commensurate with the productivity of the economy. There's not an asset that you can invest in that has no risk character to it from a creditworthiness standpoint. And so the attempt, if you will, to try and impose that monetary stimulus on a very soft economy has been so large that it risks unsettling, if you will, the perception of the quality of man-made money.
Was there ever a risk-free asset that gave you real returns?
Over the very long term, if you look at the history of government bonds, they've typically produced low single-digit real returns commensurate with the growth rate of the broader economy. And if you look at the price of gold over the very long term, it too has produced real returns in the low single digits commensurate with the growth rate of the overall economy, and that makes sense. And so these are never totally risk-free investments. Every government bond it has regime risk. There's the ability for wars and balance sheet deterioration, or the printing press has been opened in response to other factors. And gold itself, even though it's a perpetual asset because it chemically is inert, has volatility. And so there is no risk-free asset. And I think from the First Eagle standpoint, we've always invested under the assumption that there was no risk-free lunch. There was no ability to get a return for nothing. And so from our standpoint, what this juncture does for us is it reinforces the notion that if you want to produce an attractive real return over time, you need to invest security by security in enterprise, by and large, where you can find a margin of safety. And that's really the least worst way, if you will, to try and preserve capital in these times.
So what kind of instability has central bank intervention in the markets had, or what kind of instability is it creating?
Well, I think if you look around the world, when the cost of capital departs from a natural cost of capital, it typically results in some form of malinvestment when confidence recovers. And perhaps an extreme example of that has been what we've seen in China. In China, if you look at monetary policy over the last decade, unarguably we've had an easy set of policy conditions in China for much of the last decade. In fact, monetary growth has been around 15% annualized if you look at the monetary aggregates in China for the last decade. Part of that fueled by a currency that was pegged below its equilibrium value. So it's part of the overall policy toolkit. The result of those very low interest rates in China relative to the nominal growth of the economy has been a property boom of pretty epic proportions. So much so that China, a country that is roughly 10% of the world's economic activity, is consuming roughly half the iron ore and cement. So it's produced a distortion in the allocation of resources, and people have built expectations that that's going to continue into the future. Yet if it's already 50% of world demand for iron ore and cement, it cannot grow at 10% a year, at least not in that economic model. And so people build expectations on the wrong premise, and at some point inevitably that will lead to disappointing investment outcomes.
So what are realistic expectations? And I want to talk to you about First Eagle specifically. Right now at First Eagle, you're saying that equity should be the core of a portfolio, that it's kind of the least worst alternative, in your words.
Absolutely. I mean, when we look at equities, we're not trying to impart a sense that equities are bargains by any measure. It's certainly not a distressed environment that we're in right now. I would say confidence, if anything, has normalized somewhat. Whether you look at business sentiment surveys or whether you look at implied volatility, we're not in a juncture of extreme distress at the moment. And the valuation backdrop for equities on a standalone basis is neither bargain nor bubble. So equities as a whole are attractive to us not because they represent an outstanding valuation opportunity, but because within equities, the volatility of markets is enabling us margin of safety opportunities. Ultimately, we build wealth by buying good businesses at good prices. And so paradoxically, it's the volatility of equity markets in these uncertain times that's giving us wealth building opportunities.
Because you can buy things cheap.
That's right. I mean, if the market as a whole isn't cheap, you can construct a portfolio one security at a time that embodies a margin of safety. And the volatility is your friend in that quest.
How are you managing the volatility among the stocks that you own? I mean, how can you use that to your advantage?
Well, first and foremost, amongst the stocks that we own in the portfolio, if we have windows of negative volatility, that obviously provides us with an opportunity to selectively commit more capital to businesses we know and like and understand. And so if you look at the portfolios at First Eagle, what you'll find is that many of the companies are very resilient. They support strong embedded market positions, often with 40, 50, 60% market share. They have fortress-like balance sheets with net cash, not net debt. Mm-hmm. They have management teams that are prudent and rational and incrementalist in their behavior rather than expeditionary. And we understand them. And so if you own businesses like that, then the volatility ought to be less distressing. And it ought to make you feel more comfortable to commit more capital in those windows of distress.
However, in the environment that we've just come through, where you have this risk-on, risk-off phenomenon, and where basically, all ships are either go up or down, depending on which switch is turned, have you seen a differentiation in the marketplace between the quality companies that you're talking about and the lesser quality? I mean, has it made any difference in the market?
I think the single most important thing you can do as an investor in an environment like this, where there's risk-on, risk-off, is focus on your own temperament. Rather than trying to predict every zig and zag in advance, position yourself to be able to take advantage of the zigs and zags after the fact, to be able to commit capital in distress, to take advantage of it after the fact. The kinds of companies that we invest in, some of them have performed reasonably well in this environment because there has been somewhat of a flight to quality in some of these windows. On the other hand, some of them are just viewed as simply mundane. And for us at First Eagle, mundane is beautiful. If a business is stable, it's unlikely to deteriorate quickly. And most people are attracted to rapid growth. But a business that can take market share quickly might also lose market share quickly. It has fad risk. We like businesses that are likely to be around for the long haul.
So can you give us an example or two of the kinds of companies that basically represent what you look for at First Eagle? Absolutely.
I mean, you can look around the world, and there are many examples in our portfolio, but there's a couple of common threads that unite some of our larger holdings. And an example of one company would be Fanuc in Japan. This is a company that most people have never heard of, yet Fanuc is a dominant company in its particular industry. In fact, they're the world leader in computer numerically controlled systems for factory automation. These are the computer systems that power robots, servo motors, precision welding equipment, and in fact, over half the world's precision factory equipment has some form of Fanuc equipment. It's a very dominant market position. It has Microsoft-like margins, north of 40%. And the company has really dominated this industry since its inception. And these are the kinds of businesses we look for. It happens to be listed in Japan, but the vast majority of their sales are around the world. And so it's companies like Fanuc in Japan that we would look for to try and take long-term investments in this environment.
So some of your more recent investments, I understand, are Microsoft, for instance, and Cisco Systems.
It comes back to what we were talking about before, and that volatility can be your friend in markets. In the late 1990s, we would never have dreamt of investing in a Microsoft and Cisco. When everyone thematically wanted to own the new economy, these stocks were trading at ridiculous valuations. Cisco at 150 times earnings, Microsoft at very high multiples. So you were getting earnings yields below 1% in an environment where you could have bought a treasury yielding 6%. Now, in the last 12 to 18 months, there's been windows where you could buy both of these securities with double-digit earnings yields, at single-digit earnings multiples, at a time when the treasury is yielding sub 2%. And so the cumulative impact of volatility has been to totally invert the prices of these securities. So number one, we have a price today that makes sense. Number two, the passage of time over the last decade has meant that the market positions for these companies have become more, not less entrenched. Now, when we buy businesses at First Eagle, we don't like to pay for growth. But if we see a business that's embedded, that has a rock-solid capital structure, and like Fanuc, these companies have net cash, not debt, and we see a price that doesn't reflect the growth potential of the business, that's when we make a long-term investment. And we'll hopefully own these for the next handful of years.
One of the hallmarks of your First Eagle approach as well is what you call having ballast in your portfolio, stabilizing positions. And so traditionally those have been gold and cash. Explain what you mean by ballast and how important it is, especially in today's environment.
Absolutely. When you think about the concept of ballast, think about sailing across stormy waters. You know if you're going to sail across stormy waters that you're going to have to endure adverse weather from time to time. And you're going to have to do that in order to reach your destination. Now, investing is the same. If you want to produce a real return in the current environment, you have to own businesses, because there's not an alternative that's producing an attractive real return at the moment. And sometimes the waters can be stormy. But as a long-term investor, as we've discussed with respect to volatility, you want to be positioned to take advantage of those windows of crisis rather than be thrown off board. And so the willingness to own cash when you can't find good investments, and to do nothing sometimes, and then to selectively deploy that capital in windows of distress is what we mean by ballast. And beyond our cash, we've always held a strategic reserve in gold. And gold, if you will, is nature's currency. It can't be printed. And so in some ways, its value is the inverse of confidence in the man-made system. At windows when there's a lack of systemic faith, gold often does very well. So it fits together like a glove with the portfolio of businesses that we own. And so we feel between the cash and the gold, we have the resources to take advantage of crisis, because it's certainly not the environment where you can go to your clients and ask for more money.
So your position right now in gold is what, in the First Eagle Global Fund, for instance?
In terms of the bullion, we'd probably own between 5 and 6% of the portfolio in gold bullion. And then we own another sort of 4 to 5% of the portfolio in gold equities. Our feeling is if we're willing to own the gold in a vault, we should be willing to hold it in the dirt if it's cheaper.
So I know one of the mining companies that you and I have talked about before is Newcrest, right, which has mining operations in Papua New Guinea and also Australia.
Absolutely, and I think Newcrest is an interesting example of the valuation disparity that exists today between the gold bullion and the gold equities. We're in an environment where gold is in the 1600s. It was up quite a bit last year, and yet Newcrest stock was down. Now, in the past 12 months, Newcrest's reserves have not changed that dramatically. In fact, they've integrated a very important acquisition. They acquired a company called Lihir, which was a Papua New Guinea based gold miner. When you look at the company overall, their cash costs of extracting gold are in the $500 to $600 range. So they have a very good sustainable position on the cost curve. They have a strong capital structure like the other businesses that we own. And they have not only interesting existing producing reserves, and by the way, they have 20 years of reserve life.
Europe. What's your analysis of Europe, and are this continuous fault line, it seems to be the European financial system, is that creating opportunities or hazards or both?
Europe is actually paradoxically in a somewhat different situation, I think, than most people perceive it to be. If you were to aggregate all of the economies of Europe into one, what you'd notice is that the fiscal deficit as a percentage of GDP is less than half that of the US. And the current account deficit is basically in balance. It's not really a deficit at all as a percentage of GDP. And so Europe as a whole has surprisingly healthy metrics at the aggregate level relative to the US in some dimensions.
So you're starting to find European companies that you think are looking interesting. And
what we started to see at the tail end of last year is those companies that have a degree of perceived cyclicality in Europe did sell off towards the end of the year, and that started to present opportunities.
Can you mention any of the opportunities, or are you still actively?
One I can mention, and
right.
it's in the spirit of a mea culpa, because we've spoken about it in the past, is Pargesa. Because Pargesa, even though it's listed in Switzerland, is a holding company for a range of French companies that are global majors. They are indirectly the largest shareholder in Total, leading shareholder in Lafarge, the global aggregates and cement company, leading shareholder in GDF Suez, which is the utility and LNG company.
And Pernod Ricard.
And Pernod Ricard, which is a spirits leader.
Right.
Now, amongst their holdings, some of those stocks have been quite weak in the last year. Total has been soft, GDF Suez has been weak, Lafarge, the aggregates company, has been very weak, because these companies have perceived economic cyclicality, and obviously those companies have suffered in the European sell-off. But that, for a long-term investor, can present opportunity, because these are very long-duration businesses. Whether you're talking about a utility plant or an oil resource base or an aggregates mine with a 60-year reserve life, these are long-duration assets that they typically own. And so 1 or 2 bad years doesn't really determine the long-term value of these assets.
One investment for a long-term diversified portfolio. What would you have us look at now?
When you're looking for a single investment, I always encourage people to think about the mundane. And the mundane often incorporates less expectational risk. And an investment that's been featured heavily in our portfolios over the last decade plus has been a little Japanese company, not so little anymore, called Shimano. Shimano has over 50% market share in bicycle brakes and gears.
Yawn. Exactly right.
Most people who ride a bicycle would recognize the Shimano brand. They probably can't even remember the brand of their own bicycle. So this is a business that has a strong market position, that has a reason to exist. And if you look at the financials, just in a rear vision mirror, they don't look that exciting, but it's because Shimano's based in Japan. 80% of their sales are outside of Japan, and the yen's been appreciating. If you were to recast Shimano's financials into US dollars, you'd see that their sales have more than tripled over the last decade. Yet the company is priced not to grow. And in fact, people are worried about Shimano at the moment because they do have a decent chunk of their business in Europe. And a high-end bicycle is somewhat of a discretionary item, and the euro has been weak. So in the very near term, there could be some earnings risk that the market's focused on. But from a long-term investor standpoint, to own a business that controls more than 50% of its market, to own a business that has net cash, no debt, and to own a business that thinks about shareholders for the long term makes sense. And in fact, Shimano does that. Not only have they expanded the moat of their business operationally over the last decade, but they've bought back more than a third of their stock. So you're getting a lot more bicycle components per share.
Bike per share. One last question, and I'm going to preface that with saying individuals are fleeing stocks. They're very concerned about market volatility. So what's the biggest investment risk that you are concerned about?
The biggest risk people always have is actually not taking risk. Paradoxical as it may seem, in order to preserve your capital in real terms, you have to be willing to own enterprise. It's a scary environment out there. There are all these fault lines that we've talked about. But I think what helps someone overcome that mental hurdle is knowing that you don't have to own the whole market. You can view the market as a piece of marble and chip away at the pieces you don't want, so the portfolio emerges from within. That is what you want. I think if you seek out a margin of safety, security by security, you get a lot more comfortable with the notion of deploying capital at risk. And as long as you've got enough set aside in ballast so that you can endure negative periods in the market and take advantage of them, I think that gives you the temperament and the emotional ability to kind of endure that volatility and profit from risk taking over the long term. And that's the way we would think about it.
Very reassuring. As always, Matt McLennan from the First Eagle Funds, thank you so much for being with us on Wealth Track.
It's a pleasure. Thanks for having me.
At the conclusion of every Wealth Track, we try to leave you with one suggestion to help you build and protect your wealth over the long term. This week's Action Point picks up on one of Matt McLennan's strategies. This week's Action Point is make sure you have some ballast in your portfolio. Portfolio stabilizing investments come in many forms. The traditional ones are cash, U.S. Treasury bills, notes, and bonds, TIPS, which are Treasury inflation-protected securities that provide protection against inflation, and gold, the bullion itself or an ETF that holds the metal. Some stabilizing investments in volatile markets are a must. I hope you can join us next week for our Wealth Track television exclusive with legendary great investor Chuck Royce, the portfolio manager who created the category of small cap investing at the Royce Funds. He's going to tell us why small is still beautiful for long-term investors. To see this program again, go to our website, wealthtrack.com, and while you're there, check out our Wealth Track Premium service, which enables subscribers to see our interviews 48 hours in advance of the public. And that concludes this edition of Wealth Track. Thank you for watching, and make the week ahead a profitable and a productive one.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. And Research Affiliates, an efficient index for an inefficient market.